Welcome back. Goldman Sachs has put out an equity note saying that they see the Nifty at 20,700 over the next 12 months. Now, this may disappoint some who see 20,000, much earlier, going by the pace of the move since the Nifty conquered 19,000 on June 28. We managed 400 points since then in just about 7 trading sessions. But Goldman says India is the best growth story in town. Then why are they somewhat modest about their Nifty expectations? To answer that, joining me now is the author of the latest equity report, Sunil Koul, Equity Portfolio Strategist, Asia-Pacific for Goldman Sachs. Sunil, good morning. Thank you very much indeed for joining us. The pace, again, with which the Nifty has moved in this quarter, April, May, June quarter, gives the sense that 20,000 can come pretty quickly. You don't share that kind of enthusiasm?
Latha, thanks for the invitation first. As you said, we do have a target of 20,700 on Nifty on a 12-month basis. So we do like India structurally. But I think given, as you said, the last 3-4 months, the pace of recovery, not just in the Nifty stocks, but also within the broader market in mid or small caps, it does feel like both in terms of valuations with the market trading at 22 times, but also in terms of some of the risk appetite indicators we are tracking, we do think that markets may need to kind of consolidate here in the near term for the next 3 months or so. I think as you get closer to the fourth quarter, heading into the festive season, with the third quarter earnings coming through at that point, maybe the market kind of regains a bit of momentum. But for now, we think for this quarter at least, we're probably looking for markets to consolidate from current levels.
Okay, fair enough. Yes, markets have run hard. But, you have a very interesting table in your page 13 of your report, where you point out that every time the market has been over 19 times, in the next 6 months and 1 year, the returns have been 2%, 4%, and 2%. That's the average. But you also give us another table where you show the excessive returns it has given. It has run hard and continued to run hard as well on certain occasions. You don't think this could be one of them, considering the excitement about the India story?
Look, as I said, we are pretty excited about the structural prospects for India. We do think there's a lot of stock picking to do in terms of alpha. We actually had a report out a month or so back where we actually showed that India has been the most fertile ground for picking stocks in terms of alpha picking. And we actually compared 10 different markets, 7,000 odd stocks, and India has the highest proportion of multi-baggers, meaning the stocks that have given you more than 10x returns over a 5-year period in the last two decades. So I think there is a lot of bottom stock picking opportunities there. I think having said that, as I said, earnings are still growing at 15% plus compound. So we are expecting earnings to grow 17% this year, another 15% next year. So with that kind of mid-teen earnings growth story, we do think markets go higher. But I think at these levels, as you also noted, valuations at 22 times is expensive. Historically, as you said, from current levels, return tend to be moderate, which is why we have 7-8% upside in local currency terms, 10% in round numbers in dollar terms, total returns for the market, which we think is kind of fair. I think we also have to keep in mind where the macros are. So with the global growth generally kind of slowing, the rates probably higher for longer, we do think 19 times is probably fair for India at these levels. So we do bake in a bit of multiple compression in our numbers. So the way we sort of get our return forecast is that you have a 15% earnings slope, and then you get a bit of sort of 5% plus multiple compression, which is how we get to that return. I would also point out in terms of valuations that the starting level of valuations right now for the market is the highest it has been in a pre-election year. Going back for the last 20 years or so. So you also have to keep that in mind. So again, as I said, I think we like India longer term story, but at current levels, we think the returns are more likely to be moderate.
Oh, yeah. No, the pre-election thing is important. I take your point on that. After the Karnataka elections, that seemed a worry. After the Maharashtra happenings, it seems like it is pretty much in the bag, and election is hardly a threat, but perhaps a positive. But that discussion closer to time, not now. Sunil, before I get into your specific sector preferences, I wanted to ask you about the global scenario. Last week we had huge data on private payrolls. I mean, almost 450,000 jobs when the expectations were about half that. Of course, it was cooled by the payrolls, the jobs data, which was a tad lower. But there again, the hourly wages, all that is still very strong. Are you all worried that we could see more tightening than the world is prepared for? And that can be a headwind in 24 or late 23?
Yeah, that's a great question, actually, Latha. Look, I think if you look at the macro, if you step back a little bit, there have been sort of shifts on the growth side. There have been shifts on the rate side, as you mentioned. So on the growth front, it does feel like, when you look globally, it does feel like obviously China growth has faltered a little bit. And on the contrary, US growth is holding up pretty strong. And as you probably know, we have an above consensus, or have had an above consensus view on US growth. We still don't have recession in our forecast. We only have a 25% probability of US recession, whereas the street is at 60%. So we have been sort of optimistic on US economy, and it seems like that story has gone a little bit even better. Which means, I think, when you look at India, the fact that for the region overall, you've got China growth, which is slowing, but US sort of holding up pretty well. So the markets in the region, which are kind of more China sensitive, probably have more downside risk to earnings, whereas I think the markets which are more sort of sensitive to US growth probably have some upside risk. So I think India, therefore, is in the right zone, wherein we're not as worried on the growth outlook, because domestic growth looks still strong, but on the other side, I think US growth, which India is kind of exposed to through its equity markets, is helping India. But I would say I think the risks are more on the tightening side, as you said. So we do think there is one more rate hike in terms of Fed. So in July, later this month, and then Fed is on hold. But given the hawkish commentary from the Fed recently, as well as the dot plots, it does feel like there's a risk that they may actually go for another hike later in November, although that's not our base case. I think RBI, on a similar note, has been sort of sounding hawkish as well. So I would say on the margin, it does feel like you could have renewed sort of tightening risk. And if you look at the markets last 2-3 months, I think the sectors that have been more sort of benefiting from lower rates have done well. And so to the extent that if the market starts to price out any rate cuts next year, but also kind of rates higher for longer, I think that is a headwind for equity markets. We also have to keep in mind, I think, as the market kind of prices out any rate cuts, you will also see dollar continuing to be somewhat stronger, at least relative to the Asian peers, and that typically isn't a great environment for flow. So you put all of that together, it does feel like globally it could be kind of a bit of headwinds, as you put it, for the global equities in general. Okay.
Yeah, though you do point out that while the dollar strength may have some impact on capital flows, it's not a current account deficit problem, since their things are way more benign for India. Now let me ask you to talk sectors, because that's what our viewers want. Once again, more of banks is what your list is saying. Any preferences within the banks? I mean, would you go for public sector banks now? A few of them have shown remarkable growth.
Yeah, look, I mean, if you look at the last 2-3 months, actually, the sectors that have done very well is real estate, autos, some of the NBFCs. All of those actually benefit from potentially lower rates, as I said. I think banks actually have actually lagged in the last 3 months or so. Okay. So you're looking at a sector where they are still trading at sort of mid-cycle valuations, or valuations are not expensive. There is a decent kind of visibility on growth, sort of high teens earnings growth at decent valuations. They are still gaining market share from the NBFCs. In fact, if you look at the banks versus NBFCs trade, I think the fact that NBFCs have rallied in the last 3 months pretty hard, and the valuation gap has reduced between NBFCs and banks, that on the margin continues to for us to favor banks over NBFCs. So we think that's an area people will continue to prefer, especially given the fact that I think in this environment, if the market kind of consolidates, you probably want areas which have significant or decent visibility on growth. I think banks kind of check that box. As I said, I think within banks, we would prefer banks over non-banks or NBFCs. We would like private banks as well as some of the largest PSU bank also in there. I think it's the private banks and the largest PSUs which we like. Okay. Given the stability of earnings, which is an important criteria, we would kind of stick to that list in the near term.
Okay, you very clearly point out that in NBFCs you like commercial, those lending to B2B, so to speak, and not the consumer-oriented ones. Any reason why, and therefore you don't look at consumer NBFCs now?
We have been underweight that space for a while. I think we are a bit concerned about the fact that in consumer lending, the growth has been somewhat too strong, and obviously there is a lot of competition going on. So, I mean, it's not at a stage where we think there are any near-term asset quality risk, but I think it's an area which we need to be watchful for, and valuations aren't particularly cheap in that area. So, in general, as I said, banks or NBFCs, and within NBFCs, if there are higher quality NBFCs which are more into kind of B2B or kind of industrial segment, we like them more as compared to ones which are more in consumer-oriented sectors.
Well, I spoke about NBFCs also because today we have this announcement of Reliance taking one more step, perhaps, to list their retail venture. And that set the market thinking, which means the finance venture also will not be far behind. Will that mean more trouble for consumer NBFCs? Is that something that went into your thinking at all?
Not really. I think within the banking sector, I think the way we're sort of thinking about it, I think when you speak to clients, I think people are in the camp wherein they are saying, look, I mean, you can obviously get a little bit more upside in some of these names, but you have better comfort in terms of earnings visibility with banks, and they are not expensive. And so if you have that comfort, why sort of get into a segment which is somewhat more riskier and trading at higher valuations? So I think from a relative risk reward, therefore, we like banks over the NBFCs. That's what sort of was the main thought. And as I said, within the NBFCs, if you're more into sort of credit, consumer credit cards, sort of personal loans, sort of housing finance, we sort of are a little bit more cautious on that space. So which is what keeps us underweight on the broader consumer NBFCs.
Well, okay, actually, it's an extremely rich report where Sunil is pointing out to laggards who have not done so well, like, the HDFC Bank, the Kotaks, even Reliance Industries. And then there is a list called, stable growth guys, like, again, HDFC Bank, Kotak, Larsen. So it's an extremely rich report. But just one final question. I'm out of time. Sunil, what about the newbies? The Nykas, Zomatos, are they also something you would chase now?
Look, I think the risk reward on some of those names is improved. We're sort of more market weight that space. I think valuations have come down. The focus on profitability is there. I think with some concern about renewed sort of rate risks, we are somewhat still more measured in there.
Okay.
And again, I think there is a little bit difference in terms of different subsectors. But in general, I would say the places where we see the most upside right now would be banks, as I mentioned. But also, I think the broader rural recovery is the theme, which we didn't sort of speak about, but that's something we have been sort of also flagging, because that's an area which has been lagging in the last 2-3 years. We think there you could get more upside. So we're not sort of underweight or cautious on the new economy stocks, but we think risk reward still is better in some of the other pockets of the market. So we are kind of more market weight that area.
Okay. Out of time, but it's an extremely interesting report, Sunil. Thank you very much indeed for joining us and giving us a peep into the important takeaways from that report. 20,712 months. A couple of risks that Sunil points out to, El Nino and elections. Both seem now strengths, actually. The monsoon deficit is wiped out and elections don't seem the scare they seemed a couple of months back. So probably with some luck, Nifty will do much better than the 20,700. But that's a good number anyways. Wrap up on Bazaar. Chartpast is up next.